Let's unravel the active versus passive investing showdown. Two contenders in the investment arena with very distinct strategies. Active investing is like the hands-on chef in the kitchen, constantly tweaking and adjusting. It involves actively managing a portfolio, making decisions to outperform the market. And this is the art of stock picking. On the flip side, passive investing is the chill surfer riding the market waves. It involves tracking a market index like the S&P 500 and essentially saying, I'm in it for the ride. With lower management fees and minimal tinkering, passive investing is about mirroring the market's performance rather than trying to beat it.
So, why go active? Well, it's for those who believe they can outsmart the market and snag those alpha returns. Active investing is the realm of Warren Buffett's and Peter Lynch's, who've made a fortune by picking individual stocks.
On the other hand, passive investing caters to those who believe in the market's long-term growth and don't want to constantly play the stock picking game. It's a strategy embraced by the likes of Jack Bogle, founder of Vanguard, with his creation of the first index fund. What to choose? Active investing might suit those with a knack for analysis and a finger on the market pulse. Passive investing, on the other hand, is for the set it and forget it crowd, letting the market do its thing. For a taste of the numbers, imagine an active fund boasting a 15% return, but after heavy management fees, you're left with 10%. Now, 5% is pretty high, but this is just for illustrative purposes. Meanwhile, a passive fund mirroring the market scores a solid 12% with lower fees, leaving you with a comparable return.
In the end, it's a matter of personal philosophy. Active or passive, each approach has its merits. Active seeks to beat the market, while passive aims to ride its natural trajectory. It's like choosing between a thrilling roller coaster ride or a leisurely stroll as you move on with your life. And both can get you where you want to go, but when you put in the work, you can get greater rewards. All right, let's talk about the perks of active investing, that hands-on, sleeves rolled up approach to growing your money.
One major advantage is the potential for higher returns. Skilled fund managers and individual investors, they aim to outsmart the market, seeking those alpha gains that can elevate your portfolio above the average. Flexibility is another cool benefit. Spot a juicy opportunity or sense an impending storm? Active investors can swiftly navigate, optimizing their positions to navigate effectively. Customization is where active investing really shines. You get to pick and choose the stocks that align with your goals, knowledge, risk appetite, and values. You're not just following an index. You're crafting a portfolio that reflects your unique financial DNA. Plus, there's a certain thrill in being actively engaged with the financial markets. It's not just about watching numbers on a screen. It's about diving into company reports, analyzing trends, and making strategic moves based on your insights. For those who enjoy the game, active investing brings a sense of involvement and intellectual stimulation.
Sure, it's not a walk in a park. Active investing demands time, research, and quite honestly, a stomach for being a contrarian and not following the crowd. For those who enjoy the challenge, the potential for higher returns, adaptability, customization, and the sheer excitement of actively participating in the market, make it a thrilling ride. Now, Let's talk about the flip side of active investing, the bumps on the road that can make this journey a bit challenging.
First off, there's the issue of higher costs when you're investing in mutual funds. Picture this. You're comparing fees for actively managed funds and notice that they are 1%, 3% of your funds, regardless of performance. Now, how do you feel about that? What justifies these fees? Well, all that hands-on decision-making, research, and trading do come with a price tag, often in the form of higher fees. And the well-dressed fund managers want to make a tidy profit as well. Then there's the infamous hurdle of consistency. Despite the bravado of many active managers, consistently outperforming the market is like trying to hit a bullseye blindfolded. The truth is, many fall short, and the dream of beating the market on a regular basis can turn into a bit of a mirage. Now, let's talk risk. Active investing is a bit like walking a tightrope without a safety net. It can be thrilling, but one wrong step and you might find yourself in a financial tight spot. The decisions are subjective, based on predictions and analysis that sometimes miss the mark. The fund managers are managing your money and saving you time in doing your own research, but if they lose you money or fail to perform, there's no recourse. And let's not forget the time commitment of actively managing a portfolio on your own. Active investing demands attention. You're not just parking your money and letting it grow. You're actively tending to your portfolio. For those with busy schedules or a penchant for more laid-back approach, this can be a bit taxing.
So, while active investing does have its allure, it's crucial to acknowledge the drawbacks. Higher costs when you invest in managed funds. The time commitment if you manage your own portfolio. The challenge of consistent outperformance. And potentially heightened risk. All right, let's chat about the laid-back cousin of investing, passive investing. Think of it as the set it and forget it strategy that comes with some pretty nifty perks. First off, we're talking lower fees.
Picture this. You're at a sale, and the passive fund aisle has some seriously discounted management fees. That's because these funds simply track an index, like the S&P 500, and don't require the constant tinkering that active management does. Then there's the sweet simplicity of it all. You're not playing the stock picking game or trying to time the market. You're hitching a ride on the market's natural trajectory. Diversification is another cool benefit when you think about downside risks. When you invest in a passive fund tracking an index, you're really spreading your money across a bunch of different stocks. It's like having a buffet instead of putting all your money on one single dish that you might not even like. This diversification can help cushion the blow if one stock takes a tumble. And the best thing about index investing? Saving time while earning average returns from doing nothing. Passive investing is perfect for those who'd rather spend their weekends hiking, binge watching, or doing anything really other than constantly analyzing businesses. You set it up, you let it ride, and you focus on what matters to you.
So, whether you're a financial novice or just not into the daily market hustle, passive investing offers simplicity, lower fees, diversification, and the gift of time. It's like the low maintenance garden of the investing world. Less work, more enjoyment. All right, let's talk about the not so glamorous drawbacks of passive investing.
First up, you've got limited control. Picture this. You're on a road trip, but you are the passenger with a driver who won't listen to you. You have no control on the direction you're going or whether you will hit some serious speed bumps. You're just along for the ride, for better or worse. Then there's the lack of individuality. Passive investing is like joining a crowd. You're all headed in the same direction. While it's comforting to be part of the pack, it means you won't stand out or have a chance to cherry pick specific stocks you believe in. It's a bit like going to a restaurant without getting to pick from the menu. You just get what's served to you. Diversification, our friend from the benefits side, also has a downside. Sure, it cushions the fall, but it also means you're spreading your money across winners and losers. It's like having a mixed bag of candies. Some you love, some not so much. Like for me, black licorice. No thanks. So while passive investing has its perks, simplicity, lower fees, and less stress, it's not all sunshine and rainbows. You got limited control, lack of individuality, and the double-edged sword of diversification. These are bumps on the passive investing road.